Well, I hope everyone's having a good day. This is the video that I promised you over the tutorial. I know in one section we kind of got started with it, in the other section we didn't. So I'm just going to start at the beginning, and you can fast forward it or move it ahead as you see fit. So the example we're looking at is a company called Cheesy Pizza. It currently has a capital structure of 20% debt and 80% equity. The management of the company has hired you to evaluate the capital structure of the company to determine if they should change the capital structure and maximize the value of the firm. The chain is a chain of 330 dine-in pizza restaurants. They've been around for 20 years, so not a high gross company. We're assuming that they're going to grow their free cash flows by 4.5% indefinitely. Last year's free cash flows were 1.3 million, so we're going to use that later on to determine the value of operations for the company. You've met with so the first step, if you remember from our notes, was to estimate the cost of debt. So in this case, we're going to say we went out to the rating agencies. It might not be the rating agencies, it might be a bank, but we're going out and we're getting the pre-tax cost of debt, or the interest rate that we're going to be charged on taking out different levels of debt. So in this case, as you can see, the cost of debt increases with the amount of debt, and that's because the default rate increases. The more debt you take on in your capital structure, the riskier it is for the lender. We're going to be charging more for that interest, for that default risk. The marginal tax rate is 36%. The reason why interest rates increase with the percent of the firm's assets financed with debt, again, as I mentioned, because it increases the default risk. That's the first step. Really easy. I give it to you in this case. I talked a little bit in class about how you can use the WACC website and the times interest rate ratios to estimate these, but I'm not asking you to do it on your assignment or in this case. The second step is estimating the cost of equity. We're going to use the CAPM model, although I'm not a fan of it. It's useful in this case because it directly integrates the cost of debt through the beta. So as I mentioned in class, the way we calculate beta in this case is the first thing we want to do is calculate the unlevered beta. And I show how to do this below. We're going to take the existing beta of 1.2, get it right here. Their existing beta is 1.2. And then we fill in 1 plus 1 minus the tax rate, which is 0.36, multiplied by the debt to equity ratio. And remember, the debt to equity ratio in this case is going to be 0.2 divided by 0.8. And where we get that from, so we've got 0.2 up here and 0.8. The numerator and the denominator in the debt to equity ratio, again, this isn't the debt ratio, this is the debt to equity ratio. The numerator and denominator always have to equal 1. So 0.2 plus 0.8 is equal to 1. You go through and calculate this, you get an unlevered beta of 1.0344. So you go through and work this calculation, 1.0344 is your answer. And so what this represents is the beta of the firm of Cheesy's Pizza if they had no debt. They had no debt. The unlevered beta should always be less than the levered beta. So in this case, our levered beta, we start off with 1.2, we unlever it, we remove the effects of debt from the company, we get 1.034. So the next step is to take our different levels of debt and then relever the beta. To relever the beta, we use the Hamada equation like this. The beta of the levered firm is equal to the beta of the unlevered firm, multiplied by 1 plus 1 minus the tax rate, multiplied by the new debt to equity ratio. So whatever debt to equity ratio we're using there, debt to equity ratio we're using, we're going to include in the levered beta calculation. What I'm going to do, instead of trying to work this out by hand, I can actually do it in Excel, so you can see. Hopefully, this is how you'll do it for the project. You're going to see it's a lot easier to do it this way. So our debt to equity ratio in the first case is going to be 0 divided by 1 because it's 100% debt. Or excuse me, 100% equity, and we get 0. Second case is going to be 0.2 divided by 0.8. Then if you want to speed things up, you can take this divided by 1 minus the amount financed with debt, because you're always going to make those equal to 1. And it's 0.67. The next case is going to be 0.6. Oh, that doesn't speed things up. This speeds things up. You can grab that, pull it down just like that, and you're going to get 0.4 or 0.4, 40% financed with debt is going to be 0.67. 60% financed with debt is 1.5, and 80% financed with debt is a debt to equity ratio of 4. So you can see it moves up very quickly. And you're going to see the same effect with beta. Beta is going to move up very quickly as we take on more and more debt. So beta is equal to, using that Hamada equation, we're going to take the unlevered beta, which was 1.0344, multiplied by 1 plus 1 minus the tax rate of 0.36, multiplied by the debt to equity ratio. Again, where we got the 0.36, the tax rate, it's just in that tutorial area. The tax rate is given. We already calculated the estimated beta. Then the debt to equity ratio is given here. So let's see. You should have 1.0344 multiplied by 1 plus 1 minus the tax rate of 0.36, multiplied by C12, which is this debt to equity ratio. As you see, that is the unlevered beta, and that should be the unlevered beta. The next one is essentially 1.2, which was the beta of the firm with the 20% debt already. And then when we just move down, we get 1.48 for the next beta. We get 2.03 for the next, 3.68. And again, this is a relationship you should see. As you take on more and more debt, the beta should get higher. If it doesn't, then there's something wrong with the calculations. The firm is taking on more market risk, or it's becoming more sensitive to market risks, interest rate risk, fluctuation in the marketplace. The equity holders are going to have to face that more and more as the firm takes on more debt, and so the beta should increase. Our cost of equity, for our cost of equity, we're going to use the CAPM model, and our risk-free rate is given on here. It's a risk-free rate is 4%. The market risk premium is 7%. So the cost of equity is easy to calculate. It's equal to the risk-free rate of 4% plus the market risk premium of 7% multiplied by beta. So in the first case, it's 11.24%. We just pull that down again. We get 12.4% for 20% debt, 14.33% for 40% debt, 18.19% for 60% debt, and then 29.78% for 80% debt. I'm going to try to put this in here. Delete that. Do a very good job with that. Try it again. And so I'm just going to put that in there. So that fills out that first one. So we get our cost of equity. So now we have our cost of equity. We can fill in that row. We'll need our after-tax cost of debt, which is going to be easy to calculate. So what I'm going to do here, I'm actually going to highlight this. I'm going to pull it back over here in Excel. Get rid of that so you don't see it. So our cost of equity for each level of debt, we're just going to get from up here. So I set that equal to right here. Then you just pull that down again. Our after-tax cost of debt. I'm going to go back up here and get our interest rates. So to calculate the after-tax cost of debt, we're going to take these interest rates for every level of debt and multiply them by 1 minus the tax rate. So equals 0 multiplied by our tax rate, again, is 36%. So it's 0. And then we're just going to pull this down. If you're not familiar with using this in Excel, it's a great tool. I see this little square. You just put your cursor on that until it becomes a plus sign. You pull it right down. You get all of our different after-tax cost of debt. An important relationship you should see here is that the after-tax cost of debt should always be less than the cost of equity. In fact, the pre-tax cost of debt should always be less than the cost of equity. If that's not the case, there's something wrong. Our weighted average cost of capital then, we've got our cost of equity, we've got our after-tax cost of debt. We can calculate the weights now. So that's going to be equal to our weight of debt, so that's the percentage financed with debt, multiplied by our after-tax cost of debt, plus the weight of equity in the capital structure is going to be 1 minus the percentage financed with debt, multiplied by the cost of equity. And again, if I'm going a little fast for you, that's fine. Well, not really fine. I'm trying not to. But you can always just go back and rewind it and watch the part that you want to see again. So I'm going to pull this down. So what we're looking for here is the lowest weighted average cost of capital. So as we can see, the lowest weighted average cost of capital for Cheesy Pizza for the different options we have here is 10.39%. So that would tell us automatically is that 40% debt, 60% equity is preferable to their existing capital structure of 20% debt and 80% equity. So that's where we can make that decision. Now, we want to go above and beyond. We not only want to tell them what the capital structure should be that will maximize the value of their firm, but how they can go about getting there. And that's what we're going to do next. We're going to figure up the value of the firm. We're going to determine how much debt they should have, or how much additional debt that they should have, and make a case for how much they should repurchase. So the value of operations in millions. Remember, that's going to be the next free cash flow divided by the weighted average cost of capital minus the growth rate. So their free cash flows, I'm going to do this in thousands of dollars. Excuse me, well, it says millions here, so we'll go with that. They had 1.3 million in free cash flows from the case, multiplied by 1 plus the growth rate. The growth rate was 4.5%, divided by, in this case, we're going to go over here, the weighted average cost of capital minus the growth rate of 0.045. And so we get a value of operations of 20.15 million. And just as we would expect, the value of operations is maximized when the cost of finance, weighted average cost of capital, is minimized. So our next step in determining the total corporate value here is to add in the non-operating accounts. So they have 1.1 million in marketable securities and non-operating asset. So we want to add those to the value of the firm. Remember, this was in millions of dollars, so 1.1 million. This is going to be equal to the value of operations plus 1.1 million. So the total corporate value is 21.25. Fix that real quick. Okay, here we go. We get 21.25, 23.52, 24.16. That's going to be where we want to put our capital structure right there, where the value of the firm is maximized. So I'm going to go out here. I'm going to get rid of this one. my nice new table out here. It shows me how much my company's worth. So based on the results above, the value of the firm is maximized when the firm has a capital structure of 40%, 40% debt, 80% equity, 80% equity, or excuse me, 60% equity. So down below we see that the company has a market cap of 18.8 million and 1.2 million shares outstanding. They currently have 4.7 million in debt outstanding. So now we need to figure out how much debt they would need to get to in order to get that 40-60 split. So we're going to go back out here to the spreadsheet that we had. And I'm just going to put this out here to demonstrate a little bit. So the value we get, essentially the market cap value, is 18.82 million. And that's pretty close to what we estimated, what their market cap actually is right now. So they're at 4.7 million. We need to figure out how much debt we need to get to 40% debt. So in this case, what we want is to take this multiplied by 0.4. So we need to have $9.67 million in debt. Okay, we've already got 4.7, so the difference is going to be amount of debt needed, and that's going to be equal to the amount that they need to have total, 9.67 million, minus the amount they already have. So that's $4.97 million in debt they need to take out. So as a result, they're going to need to purchase some stock. So they're going to take out debt. They're going to use that to repurchase stock, and we're going to see what happens to the stock price then. So their current stock price is going to be equal to, they've got a market cap of 18.8 million, and they have 1.2 million shares outstanding. This instead, so 18.8 million divided by 1.2 shares outstanding. So their current price is $15.67 per share. And again, the way I got that is I took the amount of their current market value of equity, 18.8 million, divided by the number of shares outstanding, 1.2 million, to get the price of $15.67 per share. So we're going to take out 4.97 million. We're going to repurchase enough shares of stock to now change our capital structure. So to do that, we're going to see how many shares of stock we need to buy. How many shares can we purchase with $4.97 million? Well, we have $4.97 million. They're selling at $15.67 per share. So we're going to take 4.97 million divided by 15.67. So we're going to repurchase 317,167 shares. After we do that, so we're going to have a market cap our market cap is going to be equal to 24.16 minus 9.67. So we have a market cap of 14.5 million. The shares remaining are going to be equal to 1.2 million. That's how many we started with, minus the 317,167. So we have 833 million shares outstanding. So we want to figure up our price. So our stock price is going to be equal to 14.5 million divided by the number of shares outstanding. If I convert this to millions, that's 882,833. So to convert that to millions, I'm going to put 0.882833. So our new price per share is going to be $16.42. Now let's see, did we actually add any value? Absolutely. Here was our price per share down below, 15.67%. So by changing our capital structure, although we decreased the amount of the market cap, remember we started at 18.8 million, we actually increased the price of the stock for the stockholders, for the remaining stockholders. And so that's how we maximize value, that's how we repurchase shares, and determine the new price of the stock. If you have any questions about this as you're working on your assignment, feel free to absolutely go back over the video here. And feel free to send me an email, drop by my office. I'm going to be out Thursday and Friday of this week, but I'll be back in on Monday. I have office hours then, office hours on Tuesday as well, and feel free to ask questions in class. So your quiz for Monday is going to be over the Hamada equation. I'll either ask you to lever a beta or unlever a beta using the Hamada equation. All right. Have a good weekend.